Paying for college, buying your dream home, retiring early, traveling the world. The financial dreams that many of us have require a lot of money. It might be intimidating, but you can achieve all those in your lifetime. Today, I will show you exactly how to make your first million in 4 steps. You can get there sooner than you think by having a vision and a long-term plan. Then, I'll show you how long it will take for various income levels and share my family's true story. Hi, I'm Prudence, CPA and financial planner. I'm also a mother and an entrepreneur. I'm here to inspire and empower you to build your financial freedom and success to live the life you want and deserve. First, invest in yourself. Nobody can take away your knowledge, skills, and potential, whether in good or bad times. The more you learn, the more you'll earn. If you have employable skills and lose your job, you can find a new one. If you get unlucky and your business fails, you can start over. If you're good at investing and even the economy goes down for some time, you'd still be able to identify distressed assets and other promising opportunities. Investing in yourself is also an excellent way to fight against the high inflation we're seeing today. In any economy, companies are always willing to pay for top talents. So it's essential to become a learning machine. Multi-billionaire Warren Buffett considers it the investment that supersedes all others, and he's a good role model.
Without Warren Buffett being a learning machine, continuous learning machine, the record would have been absolutely impossible.
Second, save. Don't just work to pay your bills and credit card debt. Work to build your future as well. This means you have to spend less than you earn. Do you know that 60% of millennials making over $100,000 live paycheck to paycheck? That means even though they are making good money, they don't have any savings for emergency expenses or future spending. Wealth sits on a 3-legged stool: income, savings, and investment. And you need all 3 to be building your financial future. So live below your means, and when you get a bonus or salary increase, don't spend all of it. Put at least a part of it aside as savings or invest it instead. That way, every dollar you're saving and investing contributes to a future that doesn't require you to work all the time. And that future gets closer every day you work and live below your means. It's okay to save for your dream and splurge a little bit from time to time. A good principle to use is the 50-30-20 rule for your income, meaning 50% of your income should go to essentials, 30% for lifestyle, things like shopping, entertainment, and vacation, 20% for paying down debt, savings, and investing. Since you are watching this video, building wealth is probably one of your priorities. And if you aim to retire early, you should save more than 20%. Our family has consistently kept and invested 40% of our household income in the past several years. And our financial confidence and security grew with our portfolio over time. Third, be consistent and patient with your investments. Nobody can predict the market. So it is best to have a strategy and consistently invest in something with a proven track record over the long run, such as an index fund with a low expense ratio. The stock market is highly volatile. You must know that time in the market is more critical than timing the market. No one knows how stocks change all the time. So diversifying, meaning holding a balanced portfolio, decreases your overall risk. And especially when the market is down, you shouldn't panic and make emotional investment decisions. It's easy to think that one should get out of the market before it goes down. But the reality is that no one can predict if or when the market will go down. The S&P 500 index has generated around 10% return year over year for the past decade. And different surveys show an average retail investor only had 3 to 4% returns. Most professionals, like portfolio managers, can't beat the market consistently. So, if your current strategy is stock picking, which is emotionally taxing and time-consuming, you should consider some alternatives now. Our family's strategy has been to have almost 100% of our liquid assets in the stock market, including our tax-advantaged accounts such as HSA, 401k, 529 for the kids, and brokerage account. Meanwhile, we diversified with real estate, our primary home and a 2-unit multifamily rental property. Fourth, having a business mindset. This is a bonus rather than a must-have. It means start your own business or hold significant equity in growing companies. Like most investments, there's a substantial risk when the expected return is high, so you may not see an immediate return in the short run. However, if you keep learning from your experiences and other people and work with experts who know what they are doing, your chance of getting lucky will be significantly higher. Many successful entrepreneurs had failed business attempts before making it big, and countless good investors also made mistakes. But all it takes is one good opportunity that will enable you to achieve financial freedom or even financial independence. If you're curious about what financial independence means and how much you'd need, I made a separate video and I'll put the link in the description below. Let's dive into the numbers and see how long it would take for people with different income levels to get their first $1 million. For simplicity, my scenarios are double-income households prioritizing financial security and freedom starting from $0. They consistently invest in themselves and get 6% salary increase year over year. They maximize the benefits of tax-advantaged accounts such as 401k and HSA when they can afford to, and get 3% employer match. In addition, they put away money and invest it in a brokerage account for flexibility. Also, they purchase their primary residence with a 20% down payment as soon as they have enough money, and a few years later, add on an investment property. Also, they reinvest their net rental income in their brokerage account. That's roughly 50% of the total rental income if they manage the rental property themselves. And since they are not retiring soon, they could afford more risk to get higher returns. So all of their investments are in S&P 500 index funds, generating a 9.5% annual compounded return. For simplicity, we assume that both real estate properties appreciate at 2.9% per year, and the total rental income is a 15th of the house price and adjusted every 12 months. Following the model, Mr. and Mrs. Goodman, with a household income of $67,500, will achieve $1 million in net worth precisely in the 11th month of year 13. To have at least $3,000 a month for living expenses, they'd contribute 25% of their income in their 401k instead of maxing it out, and saving $0 of take-home pay in addition in year 1, but adding 5% every year up to 20%. That means starting year 5, they'd put aside and invest 20% of their take-home pay after contributing 25% of household income in pre-tax retirement accounts. They'd be able to afford their primary home with 20% down in the middle of the 9th year, or 8.6 years after starting their financial independence journey. It's also important to know that the top 3 drivers of their net worth are time. Their net worth would be 23% higher just a couple of years later. Income. Their net worth would be 8% higher if their starting salary was 10% higher. And investment returns. If their average return is 10.5% instead of 9.5%, their net worth at the end of year 13 would be 5.5% higher. Doubling the household income to $135,000, Mr. and Mrs. Aspire will accumulate their first $1 million in 8.5 years, which is significantly faster than 13 years, but not as much as double the speed. The couple would max out their 401k and HSA contributions at this income level and consistently invest 20% of their take-home pay every month. They would be able to purchase their primary home 4.3 years into their financial independence journey, and an investment property after another 3.5 years. And you can see that if real estate were not part of their strategy, their net worth would be 10 to 12% lower. For them, The top factors of net worth would be time, 16.7%, salary, 3.9%, and savings rate, 2.2%. Doubling the household income again to $270,000, Mr. and Mrs. Dream would be able to reach their first million in just 7 years, slightly faster than Mr. and Mrs. Aspire. And they could afford to buy their primary home 2 years into their journey, and investment property another 2 years later. And by the end of year 12, their net worth would go beyond $2 million. For them, the top factors of net worth would be time, 10.8%, salary, 5.4%, and savings rate, 3.7%. And the effective tax rate becomes more critical factor at their income level, at 0.9%, compared to Mr. and Mrs. Aspire at 0.3% and Mr. and Mrs. Goodman at 0.1%. That's probably why some high net worth people spend most of the year in a lower tax state, such as Florida or Arizona. Our family has a similar story to Mr. and Mrs. Dream. What's different is that we started with a low $200,000 household income in 2014. Our year-over-year salary increase was slightly higher at 8%. After maxing out tax-advantaged accounts available to us, we put aside a bit more in the early years at close to 25% take-home pay, and later as we had kids, it dropped to 18%. We got our first home in year 3 and an upgrade in year 7 when we moved to Arizona. Our net worth crossed over $1 million by the end of 2020, and that's the 7th year of our financial independence journey. Thanks to the incredible growth in stock and housing market in 2021, we reached $2 million by the end of the year. The surprise was our second property, which increased by over 40% in less than 2 years. Even though the stock market has witnessed some wild drops this year, in 2022, our real estate prices kept rising. Knowing that we won't be able to time the market, we continued maxing out our tax-advantaged accounts and invested around 20% of our take-home pay. I foresee a risk that our net worth will decrease in the next couple of years, but it will also rebound and keep growing over the long run. Understanding our long-term financial picture eliminated a lot of anxiety related to market fluctuations and gave us the confidence to enjoy our simple lives. I hope today's episode brought you some clarity and courage for your financial journey. If you liked it, please give it a thumbs up and share it with others. We are also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel if you want to learn more strategies to build your financial success and live the life you want. See you next time!